D. Early financial systems and the development of industrial capitalism. Introduction. The evolution of industrial capitalism cannot be understood without examining the financial systems that predated and supported it. From rudimentary accounting practices in ancient civilizations to the sophisticated credit markets and joint stock companies of early modern Europe, financial innovations laid the groundwork for the industrial transformation that would reshape global economies. In the 18th and 19th centuries, this essay traces the emergence and development of early financial systems and their pivotal role in facilitating industrial capitalism. 1. Origins of financial systems in ancient and medieval societies. Ancient financial practices. Early financial systems emerged from the need to facilitate trade, manage state revenues, and ensure the efficient allocation of resources. In Mesopotamia, as early as 3000 BCE, temple institutions developed accounting practices using clay tablets to record debts, taxes, and loans. The Code of Hammurabi c. 1754 BCE regulated interest rates and established legal frameworks for lending, early signs of structured financial governance. In ancient Egypt, scribes tracked grain production, storage, and redistribution, effectively functioning as bureaucratic accountants. Meanwhile, Phoenicians and Greeks advanced commercial finance through coinage, maritime insurance, and bills of exchange. B. Medieval European developments. The Middle Ages saw the rise of banking families. E.g., the Medici in Florence, the use of letters of credit, and the spread of double-entry bookkeeping, a technique pioneered in Italian city-states by merchants and formalized by Luca Pacioli in 1494. These financial practices facilitated long-distance trade and created the foundation for more sophisticated economic coordination. The Champagne fairs in France and the Hanseatic League in Northern Europe developed systems for credit, currency exchange, and merchant banking, prefiguring modern financial markets. 2. The emergence of modern financial institutions. A. Birth of banking systems. During the Renaissance and early modern period, banks transformed from merchant enterprises into public institutions. The Bank of Amsterdam, 1609, and the Bank of England, 1694, played crucial roles in stabilizing currencies, managing public debt, and financing state expenditures, particularly during wars. These institutions laid the groundwork for monetary policy, central banking, and government bonds, key components in modern capitalist economies. B. Rise of stock exchanges and joint stock companies. To raise capital for overseas ventures and manage risk, the joint stock company emerged as a revolutionary institution. The Dutch East India Company (VOC), established in 1602, and the British East India Company, 1600, issued shares that could be bought and sold in public markets. This democratized investment and enabled the accumulation of large pools of capital. Stock exchanges, such as the Amsterdam Stock Exchange, 1602, and the London Stock Exchange, 1698, allowed for price discovery, liquidity, and the expansion of investor participation crucial to industrial development. 3. Financial innovations and industrial capitalism are preconditions for industrialization. The Industrial Revolution in Britain c. 1760–1840 was underpinned by significant financial changes, accumulation of capital enclosures, colonial profits, and urbanization concentrated capital in private hands. Expansion of credit bills of exchange, promissory notes, and bank loans made capital more accessible to entrepreneurs. Insurance and risk management, marine and fire insurance, enabled long-term investment by mitigating risk. These financial tools provided the liquidity and stability necessary to finance large-scale industrial projects, such as textile factories, railroads, and coal mines. B. Development of capital markets. As industrial capitalism expanded, so did the need for capital markets. The 19th century saw a boom in corporate finance, with companies issuing shares and bonds to raise funds for infrastructure and technological innovation. Investment banks emerged to underwrite these securities, creating a financial ecosystem that supported continuous growth. Institutions such as Barings Bank in Britain and Rothschild and Co. in Europe became critical players in the international financial system, facilitating cross-border investments and enabling globalization. 4. The interplay between finance and industry. The financial-industrial nexus. The symbiotic relationship between finance and industry became a hallmark of industrial capitalism. Entrepreneurs relied on financiers for startup capital, while investors depended on industrial success for returns. In countries like Germany and Japan, universal banks played a direct role in industrial development. By investing in firms and guiding their strategies, this financial-industrial nexus allowed for sustained innovation, infrastructure development, and the scaling of production. B. Crises and regulations. With expansion came volatility. Financial crises, such as the South Sea Bubble, 1720, Panic of 1837, and Long Depression, 1873-1896, exposed the vulnerabilities of speculative finance and the need for regulation. Governments responded by creating securities laws, central banking authorities, and eventually deposit insurance schemes. These measures sought to stabilize the system, while preserving the dynamism of capitalist finance. 5. Global expansion and legacy. Global capital flows. By the late 19th century, industrial capitalism and its financial systems became global. European banks funded railways in Latin America, mines in Africa, and plantations in Asia. The gold standard, 1870s-1914, provided exchange rate stability, which facilitated international investment and trade. However, this global expansion also entrenched imperial finance, whereby capital flowed from colonies to metropoles, deepening inequalities and shaping development trajectories. B. Transition to modern financial capitalism. The early 20th century witnessed the transformation of industrial capitalism into financial capitalism, where financial markets, institutions, and instruments began to dominate economic life. This shift intensified after World War I, leading to new forms of speculation, monetary policy, and global financial governance. 6. Conclusion. The development of industrial capitalism was not solely the result of technological breakthroughs or entrepreneurial spirit. Rather, it was profoundly shaped by the evolution of financial systems ranging from early record-keeping and credit instruments to joint stock companies and international banks. These institutions provided the capital, risk management, and coordination necessary to support industrialization, thereby transforming economic life on a global scale. Understanding this financial foundation is essential to grasp both the achievements and contradictions of capitalism as it continues to evolve in the 21st century.